Hi friends, Namaste. I am Chandrakanth. Welcome to Mr. Chandrakanth YouTube channel. In this video, we will learn about what are the accounting concepts. So, what are the accounting concepts available in accounting? So, we will discuss the main accounting concepts in this video. So, please watch until last minute. You will get some knowledge. So, in accounting, there are different accounting concepts is there. Under the main accounting concepts, 8 main accounting concepts is business entity concept, money measurement concept, dual aspect concept, going concern concept, accounting period concept, cost concept, matching principle concept, accrual concept. So each of this concept we will discuss. So first of all, what is accounting concept? So accounting concepts are backbone of the accounting principle. So the accounting concepts are the backbone of the accounting principle. So these accounting concepts will set some basic rules, laws, regulations and assumptions. So these accounting concepts will set some basic rules, laws, regulations and assumptions which are kept in mind when entering a transaction in accounts books. So any accountant, so before going to record any transaction, so they should know what is the accounting concepts available in accounting. So what is the basic rules, laws, regulations and assumptions of these concepts. So an experienced accountants keep the entire accounts rule in mind when preparing an accounts books. Okay, any accountant or experienced accountant will keep all the concepts and the rules and the regulations and the assumptions of a accounting terminology should be in mind when preparing account books. So a good accountant must have a knowledge of all the important accounting concepts. So they have the knowledge on accounting concepts. They are the basis of accounting. Okay, they are the base of accounting. If the base is not good, then the bookkeeping would also not be good. If the base is not good means, so the bookkeeping would also not good. So every accountant must know the accounting concepts and principles. So we will discuss what are the main accounting concepts available in accounting. The first one is business entity concept or separate entity concept. Business entity concept or separate entity concept. So the business entity concept says, so we need to treat the business as a separate entity and owner as a separate entity. So we record business related transactions separately, owners related transactions separately. So segregate the business transactions separately and owners related transactions separately. So the business will treat the owner as a creditor. So the business will treat the owner as a creditor to record the book of accounts as a business perspective, not for the owner perspective. So we need to record the business transactions in business perspective only. We will see the business entity concept example. Suppose Mr. Birla started a business. He invested 1 lakh rupee. Mr. Birla started a business and invested 1 lakh rupee, purchased goods 50,000 rupees, furniture 40,000 rupees and plant 10,000 rupees. So whatever he purchased the assets, so these assets belonging to business only, not belonging to owner. Okay. So the business entity concept, so Mr. Birla invested 1 lakh rupee. So these 1 lakh will assume as a capital of the business and it treated as a liability. So whatever the capital of the owner, it treated as a liability. So now, Mr. Birla withdraw cash or goods worth rupees 5,000 for a personal purpose. So in this situation, this is a withdrawal of a cash or goods by the owner from the business. So from the business, the owner withdraw the cash or goods worth rupees 5,000. So for the private purpose, not for the business purpose. So the business will treated this transaction as a drawings of the owner. So this will recorded in owner's books, not in business books. And second one is money measurement concept. Money measurement concept means the money measurement concept refers to the transaction recorded by a business only in terms of money. Money measurement concept says, so any transaction happen in business related to money, so we need to record the transaction by using the money measurement concept. And book of accounts can record only those transactions which involves monetary transfers, money transfers. Any transactions involved in terms of money only should be recorded in book of accounts. Apart from the money transactions, we can't record in book of accounts. For example, the sale of goods worth rupees 10,000, purchase of raw material 5,000, rent paid 2,000 are expressed in terms of money. Okay, sale of goods, purchase of goods, rent paid. So these are the money related transactions. So we record these transactions in book of accounts. Third one is dual aspect concept. The dual aspect concept refers to the double entry bookkeeping. The dual aspect concept means it's a refer as double entries bookkeeping. It means each transaction must be noted in a twice. Okay, each transaction will be must noted in twice. Once it in debit side, once it in credit side. The dual aspect concept is very important because of its help balance the accounting books. So the dual aspect concept means it refers as double entry bookkeeping means, so every transaction we need to segregate two aspects. One is debit, another one is credit. So we need to record both aspects, enter two aspects of a transaction. Example, suppose you purchase a goods worth rupees 1 lakh or something. Suppose for example, goods purchased for cash. So this is a transaction happen in business, goods purchased for cash. So in this transaction, two aspects is there. So such as paying cash and received goods. Two aspects is there. So one is cash, another one is purchase of a goods. Aspects should be registered in book of accounts. So paying cash and receiving goods. So these both aspects should be recorded in books. So the dual aspect concept, so equation is there. That's called assets equals to liabilities plus equity or capital. Equity means capital. Assets equals to equity plus capital. The dual aspect concept says every transaction has a similar effect on assets and liabilities in such a way that the value of total assets is a way equals to value of liability. Because here goods purchased means goods will come, that is an asset. So now we are paying cash, that is a liability only, right? So we are paying cash and we receive goods. So by using this dual aspect concept, so we need to match the accounting books. And third one is going concern concept. The going concern concepts in accounting state that business activities will carried by any firm for an long duration, for a long term purpose only. Suppose if you started a business means, so you will run long time purpose only. You will think and start, this business will run long time purpose only. So if you start a business means, so it will run long term only. It's not close short term. This is an important assumption of accounting. It's provided based on the representing the asset value in the balance sheet. So as per going concern concept, so any business will start means the main motto of business to run a long time. To run a long term, it's not be dissolved in shortly. For example, the plant and machinery was purchased by a company worth rupees 10 lakhs and the lifetime span of 10 years. Suppose if you purchase any plant and machinery to the business, according to the going concern concept, every year some amount of asset purchased by the business will be represented in expenses and balance amount will be shown as an asset. Suppose if you purchase an asset means, so every year we should record some amount as a depreciation. So after depreciation, whatever the balance amount is there, that balance amount should be recorded as asset. This is called going concern concept. And accounting period concept. The accounting period concepts state that all business transactions should be recorded in book of account as an assumption of profit on this transaction for a specific period. Hence, this concept says that the balance sheet and profit and loss account of a business should be prepared in regular intervals. So hence, the accounting period concept, by using this accounting period concept, so the accountants will prepare the profit and loss account and balance sheet at the accounting period. So accounting period is there. So at the time of 6 months once or yearly once, so we'll prepare the book of accounts like calculation of a profit and loss, tax calculation, ascertaining the financial position, etc. So by using this concept, we will prepare financial statement 1 month basis, 3 months basis or 6 months basis or 1 year basis. Usually accounting period concept says one accounting period means 1 year. That comes under calendar year or financial year. Okay, calendar year or financial year. The accounting period concept will record the business transaction. Usually 1 year is considered as one accounting period, which may be a calendar year or financial year. The calendar year means it begins with January 1st and ends with December 31st. Whereas the financial year means April 1st start and ends with 31st March. That's called financial year. And cost concept. Another concept is cost concept. This concept allows for the value of an asset to be noted in balance sheet at the price at which it was purchased or cost price. So this concept allows for the value of an asset to be noted in balance sheet. Suppose if you purchase an asset worth rupees 1 lakh, so after 1 year, so the asset will be depreciated. So by using any asset, it will be depreciated. So every year the asset price will be reduced. Okay, we need to record the after depreciation value. What is the current value of an asset? That is the cost concept says. And matching concept. The matching concept refers to reporting all the revenues and expenses in same time period. The revenues and expenses of a company must be recognized by a company under same accounting period only. So the matching concept says, so every expenses and every revenue should be recorded in same accounting period only. This is very important because if company does not recognize the expenses and revenues under same accounting period, it would lead to mismatch between the profit and expenses. As profits may be overstated due to the mismatch between the accounting timelines. So the expenses and incomes should be recorded one particular financial year or one particular accounting period only. So we need to record the revenues and expenditures. Whatever happened during the one particular year, we should record same accounting period or same financial year only. That says matching principle concept. And last one is accrual concept. The best example of the accrual concept is, a lot of times suppliers are not paid exactly when they deliver the goods. The payment time can be range from 1 week to 6 months. Okay, any supplier will not pay the amount exactly when they deliver the goods. The payment range may be between 1 week to 6 months. So when they deliver the goods, at the time they should record as a income. So those goods were delivered and not the time when these goods were paid for. So the delivery time is different. So at the time we need to record as an income. So the amount will pay after 1 month or 2 months. Okay, after 1 month or 2 months we will pay. So by using the accrual concept, so the transaction happen one day, or the payment will happen on another day. This is called accrual concept. These are the main 8 accounting concepts. I hope this video will help you in future also. Thank you.